Welcome to everybody to this third debate, the last one. And we are now, let's say, exiting the Eurozone, looking more at the global environment. And we have three big themes, global shocks, policy spillovers, and geostrategic risk. And I think we have a stellar panel to deal with all these three issues. Geostrategic risk, we have Willem Buiter from the Council of Foreign Relations. We have Nouriel Roubini, who has written a book about global shocks. And of course, we have, first of all, Fabio Panetta, policymaker who I presume will be able to tell us, enlighten us about policy spillovers. The rules of the games are as usual, 15 minutes for the initial speakers, and then that will be followed by the lead questionnaires. I will follow the order which is on the program, which is Fabio Panetta, member of the European Central Bank. The floor is yours.
Good afternoon, everybody. First of all, let me thank the organizers, in particular, Volker, for inviting me. It's a pleasure to be here today. When I was invited to this conference, I thought this would have been a nice occasion to have a relaxing, quasi-academic reflection on some interesting topics. After all, I thought market conditions are calm. And we know how it ended. And then I decided to stop my intellectual holiday before it started. And so I will try to tie the topics that Daniel just mentioned to the ECB monetary policy. By the way, my comments today, let me do a small advert, are in an abridged version of the full speech which is on the website of the ECB. So we are, in the euro area, still going through a sequence of global shocks that are disrupting economies around the world, and we are now seeing tensions in banking markets. The swings in activity and prices have presented policymakers with the challenge of identifying turning points in underlying dynamics at a time of disruption in the economic and financial sector. Inevitably, we need to navigate between the risk of underreacting, which could prolong the inflationary effects of these shocks, and that of overreacting, which could in turn transform volatility into instability. Three principles can help guide our monetary policy decisions in this context. First, given the prevailing uncertainty and the ground we have already covered in tightening our policy, we must remain fully data dependent and avoid pre-committing to any specific policy path. Second, we need to monitor the effects of our measures and the way our different instruments interact with each other. In particular, we should continuously assess the combined effect of raising rates and reducing the size of our balance sheet. I will explain this in detail. And third, given the global nature of the shocks we are facing, we need to consider how they are transmitted across markets and economies, as well as the potential spillovers from policies adopted abroad. I will start by illustrating the global shocks and the uncertainty they create. I will then turn to the policy response to these shocks and their spillovers across jurisdictions. And then I will outline what this means for our monetary policy. Let me start with the shocks and the associated uncertainty. Over the past 3 years, we have faced considerable uncertainty from both domestic and global shocks. A major source of uncertainty relates to the pass-through of global shocks and their unwinding. Indeed, the unprecedented sequence of domestic and global shocks have made it difficult to distinguish supply-demand imbalances triggered by the pandemic and the energy crisis from persistent, self-sustained inflationary dynamics. As this chart number 1 shows, the post-pandemic reopening of the economy gave a sudden boost to demand at a time when supply disruptions had not yet been resolved. This led to persistent bottlenecks. Firms reacted by building up inventories and hoarding labor, fueling inflationary pressures. As a result, both demand and supply progressively contributed to inflation in 2022. The boost to activity from the reopening is now fading. As shown in chart number 2, bottlenecks have largely faded out. Firms are starting to run down their inventories, as you see from this chart number 3. This should dampen price pressures in the coming months. Demand is in fact showing signs of weakness in both the US and the euro area. And in China, the reopening will have an ambiguous overall effect on global inflation. It could dampen prices in sectors where China is a net exporter, such as goods, and increase prices in sectors where it is a net importer, such as commodities. The energy crisis has also played a major role in the volatility of activity and prices. The sharp increase in wholesale prices has raised not only energy and food inflation. Chart number 4 shows how it also indirectly increased core goods and services inflation. These effects are starting to be reabsorbed. As you can see in chart number 5, lower energy and commodity prices have translated into lower energy inflation, and they should eventually pass through to food and core inflation consistent with the easing in pipeline pressures depicted in chart number 6. This is compressing medium-term consumer inflation expectations and might temper catch-up wage demands. But how quickly these effects will be reflected in the inflation data is uncertain. The unwinding of inflationary pressures has triggered concerns about the risk of second-round effects, especially in view of the tight labor market conditions in advanced economies, which we see in chart number 7. In the euro area, medium-term inflation expectations remain anchored at our target. Robust wage growth over the next 3 years is also consistent with our projections, which indicate that inflation will gradually fall to around 3% by the end of 2023 and around 2% by the middle of 2025. But the risk that wage dynamics could make high inflation stickier and eventually feed into inflation expectations is high. This risk needs to be closely monitored. Opportunistic behavior by firms could also delay the fall in core inflation. Chart number 8 shows that unit profits contributed to more than half of domestic price pressures in the last quarter of 2022. And as you see from chart number 9, in some industries, profits have increased strongly amid fast rising prices. This suggests that some producers have been exploiting the uncertainty created by high and volatile inflation and supply-demand mismatches to increase their profits. We should monitor the risk that a profit-price spiral could make core inflation stickier. Conversely, a normalization of profits could help bring down core inflation and reduce the risk of second-round effects, as wage demands could be accommodated without leading to an increase in prices in response. Let me now turn to the second major source of uncertainty, which stems from the global policy responses to the shocks and the spillovers of these responses. We have already seen this. For instance, the US's outside fiscal stimulus in response to the pandemic boosted the demand for durable goods, as you see from chart number 10. But this created a negative supply shock in other countries. We are now facing a simultaneous and rapid global tightening of financing conditions, as you see from chart number 11. And this is creating financial and policy spillovers, as you see in the next chart, chart number 12. Right. For example, monetary tightening in the United States results in tighter financing conditions in other jurisdictions, including the euro area. This adds to the risk of over-tightening if central banks do not factor in the feedback loops they create. In the euro area, the effects of monetary tightening are already starting to be visible and well visible. The monetary aggregates M1 and M3 are slowing down rapidly. Chart 13 shows that in real terms, their growth rates are in negative territory and at historic lows, below the levels of 2008 and 2011. And as the next chart, chart number 14 shows, bank credit is also decelerating very rapidly. As a result, it is declining as a share of GDP faster, in fact, than in previous tightening episodes, as you can see from this chart, chart number 15. These developments are related to our policy normalization. So we should not be too surprised. But the size and the speed of the adjustment indicate that the transmission of our monetary policy might have become stronger, much stronger than in the past. The global tightening may also be amplified by the recent financial tensions in global banking markets. Aside from their impact on confidence, these tensions will make banks more sensitive to deposit outflows, inducing them to transfer the rate hikes more rapidly and most likely to a greater extent to their customers on both sides of the balance sheet. For a while, banks may also become more prudent about lending and decide to retain cash as a precautionary measure. In the euro area, our bank lending survey was already pointing to a tightening of lending standards for firms and households before the recent tensions, and this tightening may aggravate the drop in credit growth in the coming months. In addition, major central banks have been simultaneously raising rates and reducing the supply of liquidity through quantitative tightening policies. This could make the policy adjustment bumpier. There is no reliable experience we can draw on to examine the combined effects of rate hikes and quantitative tightening. There is no experience anywhere. And it is hard to assess how a contraction of the balance sheet of the central bank affects financial markets, especially if it happens in conjunction with an abrupt increase in interest rates. The LDI crisis in the UK and the crisis of Silicon Valley Bank in the United States suggest that sudden adjustments may have an impact on the transmission of monetary policy and even give rise to severe financial tensions. In the current context, weakening growth prospects and heightened uncertainty may lead investors to move from risky assets to risk-free assets. And when the supply of liquidity is contracting quickly, they may spur a dash for cash, reinforcing the effects of the sharp increase in policy rates and exacerbating financial vulnerabilities. In fact, as this chart, chart number 6, shows, in the US, high-quality liquid assets, this is the chart on the right, high-quality liquid assets are unusually offering higher returns than risky assets at a time when liquid assets are being withdrawn from the system. So there's an increasing demand for liquidity in a phase of very high uncertainty. Simultaneously, we have a contraction of the supply of liquidity and a tightening through hikes, rate hikes. So the result could be that you force a dash for cash, and this could have undesirable consequences on financial markets. Again, we have seen this in the UK, we have seen this in the US. As available liquidity shrinks, both in aggregate and for most banks, the supply of lending could also contract rapidly. Chart 17 shows ECB estimates that suggest banks with lower excess liquidity are more likely to reduce their supply of credit in response to policy rate hikes, and the increase in their lending rates is likely to be larger. So liquidity is adding to the tightening. So how should monetary policy operate in an environment characterized by high uncertainty, strong spillovers, and financial vulnerabilities? First, monetary policy must remain fully adaptable to changing developments, given the prevailing uncertainty, the lags with which it operates, and the risk of sudden financial tensions. This requires a data-dependent approach that does not prejudge future policy decisions, and this is what the President explained today. Second, our tightening must be calibrated prudently. This is because it is already having a strong impact on financing conditions and because we want to avoid undesirable financial volatility. Third, in order to avoid financial tensions which could hamper our disinflationary policies, we should rely on how our policy rate as the key instrument to steer our stance, and we should be measured and predictable in the normalization of our balance sheet. We should continuously monitor investors' exposure to interest rate risk and liquidity risk and carefully analyze the impact that the decline in liquidity may have on the supply of credit, especially in a financial system that heavily relies on banks. We must stand ready to intervene in a timely manner to counter possible market dysfunctions. And we have the instruments to adjust the provision of liquidity and ease collateral conditions as necessary. Finally, all policymakers should be tackling inflation on all fronts. Firms' profiteering strategies that increase inflation and the risk of second-round effects would trigger a monetary policy reaction. But other authorities should intervene here. The appropriate response to excess corporate profit is not more fiscal support to compensate consumers for high prices of goods and services. Rather, it is to intervene to prevent any abuse of market power. Let me now turn to how monetary policy should address spillovers. We must take into account all the relevant information when taking decisions, and that includes developments outside the euro area. Given the global nature of the shocks we are facing, we need to consider how they are transmitted across markets and economies, alongside the potential spillovers from the policy response to those shocks. This is what we are doing. And in response to tensions in international funding markets, we have worked with other major central banks to enhance the provision of US dollar liquidity through our standing liquidity swap line arrangements. At the same time, we need to tailor our policy response to the outlook for the euro area and avoid passively importing financing conditions from abroad through policy spillovers to interest rate expectations and long-term interest rates. We can reconcile these two objectives if we calibrate our policy appropriately and communicate our reaction function clearly. When calibrating our measures, we should consider the restrictive impulse coming from the global tightening and from the vulnerabilities that are emerging in the financial sector abroad. But the clarity of our communication is also crucial, especially in view of the current financial tensions in global markets. So we need to set out a clear reaction function and stick to it. Our latest monetary policy statement did just that. Let me conclude. A string of shocks has created uncertainty for economies around the world. And while my remarks today have focused on the current economic situation, we may well see longer-lasting changes to economic structures as supply chains are reconfigured to increase resilience to global shocks and align with shifting geopolitical strategies. In this environment, we need to continuously assess the combined effect of our different policy instruments, the risks of non-linear effects, and the spillovers from policies adopted elsewhere. Our monetary policy should be data-dependent and adaptable, and our communication should be shaped on the basis of our monetary policy reaction function. In a recent speech, I summarized my thinking by saying that we do not want to drive like crazy at night with our headlights turned off. This is a memory of when I was young, famous Italian songer, 42 years ago when Willem, we were together in London. 40 years ago, but no, we were babies 40 years ago. I wasn't born yet. Yeah. I was taking care of him because he was a kid. And the recent financial tensions have made this conviction even stronger. Thank you very much.
Maybe Nouriel can provide us with the headlights to see the challenges ahead.
Good afternoon, everyone. Volker, thanks very much for inviting me. I'll try to cover global shocks, geopolitics, and the policy issue at the same time. If I had to summarize my message in maybe one line, I would say I have a view that the era of the great moderation of low inflation and reasonably stable growth is over, and we're entering a new era, a regime change of what I call great stagflationary and debt instability. And I'll try to explain why we are in a regime change. Most people explain the great moderation and the low inflation we had until last couple of years as being based on the policies of inflation targeting, either single mandate or dual, that Europe, US, and other advanced economies followed following the shocks of the 1970s. I would argue that actually more than inflation targeting, the reason why we had low inflation was that we had a series of very long-term, persistent, positive aggregate supply shocks that kept inflation low. We had trade liberalization and globalization, maybe even hyper-globalization for a few decades. We had migration from poor to rich, from south to north, that kept a lead on wage growth in US and Europe. We had neoliberal economic policies and policies of deregulation that created more competition. We had, of course, a weakening of labor and unions, especially in the US, but even in Europe, with massive technological innovations from the internet to high tech that led to positive deflation and stronger productivity growth. And after the collapse of the Soviet Union and the opening of China, we had also a few decades of a geopolitical peace dividend that led all these countries to join the global labor supply and the global markets. China, and India, 2.5 billion people joined production of goods, of services, and the Soviet Union production of raw materials. And that was, of course, disinflationary. Then suddenly, in the last couple of years, we've had a rise in inflation. And of course, there has been a debate on how much of this rise in inflation was due to bad policy, excessively loose monetary, fiscal, and credit easing, too much and too long compared to the shock of COVID, or how much of it was due to, unquote, bad luck, a series of negative aggregate supply shocks. Of course, the initial impact of COVID on production of goods and services, on the supply of labor, and on global supply chains, the impact of the brutal invasion of Ukraine by Russia on oil, energy, food, fertilizers, industrial metals, and until recently, the impact of the zero-COVID policy of China on, again, production and global supply chain. The argument I would like to make is that even if these negative aggregate supply shocks were to be fading out, and some of them may, there are at least 10 medium long-term negative aggregate supply shock, it's going to imply that over time, potential growth is going to be lower, cost of production is going to be higher, and if then we have loose monetary and fiscal policy, and I'll argue why we'll have them, then we're going to end up with inflation and with stagflation, lower growth, if not recession and inflation. I'll be very brief. The 10 forces that reduce potential growth and increase cost of production inflation are: 1, deglobalization and protectionism. We've gone from talking about free trade to talk about fair trade and now secure trade. 2, we've gone from offshoring of manufacturing to China and low-cost countries to now talk about reshoring or friendshoring, from just in time to just in case global supply chains that are redundant, that increases cost. 3, we have aging of populations in US, in Europe, in Japan, in advanced economies, but also in key emerging markets, China, Russia, Korea, Taiwan, and others in Asia. 4, now we have restriction to migration from south to north, from poor to rich, that in the past kept a lead on wage growth. The migration policy, I would argue, of the Biden administration are no different than those of Trump. And in Europe, same story. We have now also a geopolitical depression and a decoupling between US and China, and not just US and China, but between US and the West on one side, China, Russia, Iran, North Korea, Pakistan, and other friends and allies of that group. That's going to lead to decoupling, to fragmentation of the global economy, to balkanization of global supply chains, and to restriction to trade. They're going to be stagflationary. Global climate change is also stagflationary in at least 2 dimensions. I'm all in favor of trying to deal with global climate change and have a green transition, but we've been bashing fossil fuel producers. They've massively underinvested for the last decade into new capacity, but the increase in production of alternative green energy has not been compensating for the fall in capacity in fossil fuel. That's why Brent was already $100 per barrel even before the Russian invasion of Ukraine. Of course, desertification, lack of water, and droughts lead to a collapse of production of agricultural goods and leads to food inflation. That's why food inflation was also severe before the Russian invasion of Ukraine. Global pandemics, as we have learned in the case of COVID-19, has negative supply shocks that are significant, and for reasons I'm not going to discuss right now, unfortunately, COVID-19 is not going to be the last of these global pandemics, and is not going to be the more virulent. We're going to have more severe ones in the future. We have also cyber warfare is going to become significant, that either damages production, shuts down production, or if you are a firm and you have to defend yourself against it, you have to spend a fortune to protect yourself. That's stagflationary. We have a rise in income and wealth inequality that now is leading a backlash against it, and fiscal policies, rightly so, because others will have social instability, are leading to policies pro-workers, pro-union, pro-labor, pro-unemployed people, pro-partially employed people, pro-minorities. Otherwise, we'll have social strife. Finally, we have increasingly weaponized the US dollar, but in the case of Russia, not just US dollar, but also euro and other reserve currencies. That leads to 2 problems. 1, sand in the wheel in the international payment system that is stagflationary, and 2, eventually, it might even lead to de-dollarization that will be also debasement of the dollar with inflationary consequences. So the point is there are at least 10 forces that are stagflationary. On the demand side, I think that the fight against inflation by central bank is constrained by the following issue. It's not just an issue of whether there is fiscal versus monetary dominance. And in a world in which there is too much public debt, raising interest rates may lead to a debt crisis on the public sector. But as the economists at the BIS have pointed out, we're in a broader debt trap. The sum of private and public debt as a share of GDP has exploded. Globally, was 100% of GDP in the 70s, was 200% of GDP by 1999, and last year was 350% of GDP and rising. In advanced economies, 420% of GDP rising. In China, 330% of the GDP rising. So if central banks want to fight inflation and raise interest rates enough, you have not only the risk of a hard landing, but also a risk of financial distress. That ratio become unsustainable, and the financial distress make the hard landing more severe. And of course, a hard landing is more severe, can lead then to more defaults and lead to greater financial instability. So monetary dominance is out, fiscal dominance is in, financial dominance is in. There are other reasons why I think structurally inflation is going to be on average higher. And I'm not talking about the double-digit inflation or high inflation. I think that average inflation in advanced economies could be, instead of 2%, say 6%. Historians suggest that whenever you have wars, those wars lead to larger deficits and eventually monetization that is inflationary. That's what Neil Ferguson and others have shown. Today we're facing 5 wars we're going to have to fight over the next decade or two. One, we have already caught and hold wars around the world that are going to imply that US is going to spend more on defense and security, Europe, Japan, India, China, Israel, Middle East. We're in a world of geopolitical depression. Everybody will have to spend more, either to prevent hot wars, or to fight them, or to even deal with cold wars. Secondly, we'll have to fight a war against global climate change. It's going to be costing us trillions of dollars, whether it's mitigation or adaptation. 3, we'll have other severe pandemics. So either we're going to fight to prevent them in advance, or if we don't do it like in COVID-19, the fiscal costs are going to be used ex post. 4, a combination of still continued globalization and robotic, automation, machine learning, quantum, and automation implies there'll be massive technological unemployment, connected also to globotics. We'll have to protect those who are left behind and they're losing, and that implies a larger social safety net, more spending as a share of GDP. And there is so much income and wealth inequality, they will have to spend more to protect those that are left behind. That's going to be spending more. For 5 reasons, spending is going to be higher as a share of GDP. Taxes may go slightly higher, but they're already so high in Europe and most advanced economies that limits to how much they can go higher. So if spending is higher and taxes don't rise as much, you have larger structural budget deficits. Either they crowd out growth, or they cause unsustainable debt situation, or eventually central banks will have to monetize them. Central banks are neither stupid or evil. They're very smart. But in a world in which there is too much debt and there'll be more debt, eventually they'll have to monetize it. And as I said, I speak about just single-digit inflation that is in the middle levels, not about hyperinflation or even high inflation. Now, what are the consequences of that? Last year, long rates in the US went from about 10 years at 1% to 3.5%. 2 years ago, bonds were minus 50 basis points, today around 2.5%. That's a change of 300 basis points. People pointed out that unexpected inflation reduces the real value of nominal debt. Yes, on the side of the debtor. What happens on the asset side? The value of long-term bonds falls in price when the yield goes higher. The FDIC has estimated that the US banks alone have about $620 billion of unrealized losses on their own securities. Their capital is about $2.2 trillion. So the average unrealized loss is 28% of their Tier 1 capital. For some smaller banks, it's 50, 60. SVB, of course, was 90% or more. However, it's not just the banks. US banks have about $17.5 trillion of assets. The average maturity of their assets, both loans and so on, is 4 years. So whenever you have a rise in interest rates, given the current rise in interest rates, the value of those assets falls by about 10%. So the loss of a 17.5 is 1.75 trillion, with a capital of about 2.2 trillion. You have $20 trillion of US long-term debt, dollar denominated, either treasuries or YEM debt or high spread. Yields are higher, the price is lower. We're speaking about $3-4 trillion of losses scattered around the financial system among investors. What about Eurozone and European banks? I've not looked at them. I have no idea. I'm sure the ECB will do so. But I'll point out the following thing. In 2020, as I pointed out, there were $18 trillion of public debt equivalent in Europe and in Japan that then yield that was negative, up to maturities of 10 years. And bond yields were minus 50 basis points. Today, they are 2.5, 300 basis points increase. There must be some losses. I don't know if they're in the banks. I don't know if they're in the pension funds. I don't know if they're insurance companies. I don't know where they are. But those losses are somewhere in the system, and you have to ask yourself what will be the implication. So saying things are fine in Europe and not in US, I think might be a little bit naive. Additionally, suppose I'm right, and suppose that average inflation in advanced economy were to be, over the medium term, say 6% rather than 2%, then 10-year treasury yields will have to be in equilibrium at least 8%, 6 for inflation and 2% real, because if inflation is high and volatile, the inflation risk premium have to be positive, say 2%. Last year, bond yields went from 1% to 3.5% in US, and bond lost more money than S&P. 20% loss in price, while S&P fell 15%. If they have to go from 3.5% to 8%, that's another 50% of losses, another trillions of dollars of losses. They're going to have a systemic effect. Those are the consequences of what happens when you have even a moderately higher inflation. So 60-40 doesn't work in this kind of a world. Today, we're worried about market risk and duration risk, but if these stresses and much higher nominal and real rates are going to lead to a debt crisis and hard landing, of course, we're going to start to worry not about duration and market risk, but about credit risk in a hard landing situation. So this morning was a lot of discussion about separation between monetary policy for price stability and using macro-pru and liquidity for financial stability in a situation in which inflation remains persistent and you have to increase nominal and real rates. Eventually, you'll have a debt crisis, and using only liquidity is not going to be a solution. You'll have to use monetary policy that may become inconsistent with your inflation target. Few observations about deglobalization. Whether we call it deglobalization or globalization or slowbalization or reglobalization, it's clear that there are increasing restrictions to trade. Trade in goods, in services, in the movement of capital and FDI, movement of labor, technology, data, and information. Initially was the concerns about jobs of low value-added manufacturing workers in advanced economies. Then it became resource nationalism, then environmental standards, then labor standards. Today, of course, geopolitical depression is going to divide the world. But that deglobalization is going to have significant economic and financial impact. It's going to reduce growth, it's going to increase cost of production. Prima facie example, take the UK. Why is it doing so much worse than the Eurozone in spite of having the same shock? A self-inflicted goal, Brexit, that reduces trade, increases cost of production, restricts the movements of labor, and therefore is more stagflationary. So if you have serious deglobalization, you get severe stagflationary shocks. Let me conclude with some observation about geopolitical risk. Today, there is a hot war in Ukraine, and unfortunately, with the spring coming, it's going to get worse. Whether it's going to involve NATO, whether it could become unconventional, we don't know, but that's a tail risk. I was just recently in Israel, spent a few weeks there. Israel is realizing that Iran effectively has become a threshold nuclear state. So they'll have to make a tough decision on whether they're going to strike Iran or use deterrence. And chances are they're going to strike Iran. The impact on energy and oil prices could be more severe than 73 and 79. And of course, the Cold War between US and China is coming colder by the day. And now the question that geopolitical strategists ask themselves is not whether there will be eventually a war on the issue of Taiwan, but only when that's going to be happening. And of course, you have already a policy of containment of China, but US with a restriction on US chips and so on. And there are going to be an escalation of these things. I'll make the final observations. In the 1970s, we had stagflationary shocks, the 12 shocks of 73 and 79, but we had very low debt ratios, 100% of GDP. So we did not have a debt crisis in the US or in Europe. Of course, we had a debt crisis in Latin America because they borrowed like crazy and Volcker spiked prices, interest rates at 20%, Mexico, Argentina, Brazil defaulted. After the GFC, we had a debt problem, household debt, mortgage debt, housing debt, bank debt, but we had a negative aggregate demand shock, a credit crunch, and with low inflation and deflation. So we could do massive monetary and fiscal and credit easing. Today, we have the worst of the 70s in terms of negative supply shocks and debt ratios that are much higher than they were after the GFC. And speaking about geopolitical risk, the first era of globalization and the first industrial revolution did not prevent World War I. And after World War I, what did we have? We had the Spanish flu, we had the stock market crash of 1929, with the beginning of the Great Depression, with trade wars, with currency wars, with massive defaults and financial crises, with inflation and then deflation and then hyperinflation, and then eventually unemployment rate at 20%. The Nazis came to power in Germany, the fascists in Italy, Franco in Spain, and the militarists in Japan. And then we had World War II, and then we had the Holocaust. So we had 30 ugly years between 1914 and 1945. But guess what? As ugly as those 30 years were, if you think about the world today, in that period of time, you didn't have to worry about global climate change destroying the planet. It was not even an issue. You didn't have to worry about AI destroying most jobs, and is an issue today. You didn't have to worry about implicit liability coming from pay-as-you-go social security, pension, and healthcare system for the elderly that are another 100% of GDP today, because at that time we had just passed social security, and the average US worker was dying before he was getting his or her first paycheck or social security tax. And as ugly as World War II and World War I were, they were mostly a conventional war. And luckily, it was the US who got the bomb at the end, rather than Nazis or the Japanese. And unfortunately, the bomb was used to stop the war with Hiroshima and Nagasaki. If there was a war between great powers today, and all the great powers have nuclear weapons, that's not going to be a conventional war. It's going to become an unconventional war, and it's going to be a nuclear winter. So in 4 dimensions, things in terms of geopolitics and other things are much worse today than between 1914 and 1945. Okay, so on that cheerful point, okay, I'm going to stop here. Thank you.
From that perspective, things can only improve.
You are worried for inflation.
So inflation seems to be becoming the least of our worries. But Willem is now with the Council of Foreign Relations, so perhaps you can give us some insights on whether all this gloom and doom will actually come about.
Well, thank you. It's a pleasure to be here. Thank you for inviting me. I don't know whether the world is quite as doom and gloomy as Neyer outlines, but it certainly is as crazy. I mean, I never thought that I would live to see the day that holders of cocos would be declared junior legally to regular shareholders. So this is the world we live in, so never mind. Okay, I'll try and say something about 4 issues. Are we faced with global stagflation, deglobalization, policy spillovers and coordination, and the central bank response to all things bright and beautiful? As regards, are we faced, do I advance this myself or does it happen for me? Okay, I can do this. It worked. It's a miracle. Okay. Yeah. Okay. A screen. My goodness. Okay. As regards secular stagnation, as regards global stagflation, are we faced with it? Yes, in the short run. No, in the long run. We are faced with secular stagnation, the real side of it: demographics, deglobalization and protectionism, climate change, environmental disasters, political resistance to growing inequality, and the costs to efficiency this will impose, and excessive debt are just some of the drivers of secularly long real growth in most of the advanced economies and many emerging markets. We will have episodic, transitory stagflation, where we have it now, driven by adverse supply shocks or combined negative supply and positive aggregate demand shocks, with certainty virtually. But secular stagflation is, I think, unlikely because long-run above-target inflation is a monetary policy choice, and I think few central banks are willing and will make it. and they have the tools to prevent it. There is no upper bound to the interest rate. Yes, there will be pain, but we can live with it. As regards whether or not we have faced this global stagflation, no, yes, because we've had almost perfect coordination of monetary policy among the advanced economies, they're all behind the curve. Right? That is the one element of coordination. Nobody's been on time. The record, and I'll just put these figures on because I'll look at a few of them. In what follows, I'll briefly go through a Taylor rule exercise, and for that I will use the lowest inflation rate, current inflation rate that I could come up with, which is always core inflation, or its equivalent for countries like Canada, where they call it inflation trim, which is actually a better measure than our core inflation measure. And in the US, I will use the PCE deflator, which again lowers the inflation rate. So I'm being conservative here. The question is, what does the Taylor rule suggest where interest rates should be? Right? We know what the Taylor rule is. It sets the policy rate, right, as a function of the short neutral nominal interest rate, as I take 2.5%, which I think non-controversial. It may well be higher now that real interest rates are trending up again. Something that depends on the deviation of inflation from target, with the coefficient that I take to be 1.5, the original Taylor rule specification, and then the output gap, which actually plays very little role in what I'll be talking about, because most of the countries I'll be looking at don't have a meaningful output gap, or if they have one, it's positive, and I will be again conservative in my estimate of the Taylor rule interest rate by assuming it to be 0. Goodhart did this in February, about a year ago, and came out with the US at 6% and the UK at 5%. That's where the interest rate should be. I come out significantly higher than that. The numbers are here. I'll just talk about the Fed and the ECB, because they are the fun ones. The inflation rate for the Fed, PCE core inflation 4.7%, so 2.7% over. Add that 1.5 times to the neutral rate, you get 6.55 as the target policy rate. They're only 200 basis points behind the curve, so they're getting there. The ECB, of course, core inflation is 5.6% on the most recent estimate I could find, which gives us a Taylor rule rate of 7.9%, which is some distance from where we currently are. I won't go through the other ones, but just want to point out that even Japan, where on my very conservative estimate of the core inflation rate at 3.2%, which subtracts energy costs as it should be, what they call core inflation just takes out fresh fruit. But even they should have the policy rate according to the Taylor rule at 3.8%. Now, I'm not taking this completely seriously because the Taylor rule ignores financial stability considerations, including international repercussions. And these are serious matters. A solution to that, analytically, is to have a partial adjustment Taylor rule, right? To have some weight on the actual Taylor rule rate of inflation, and then 1 minus gamma times the lagged inflation rate. Well, in order to reproduce anything like the current rate of inflation, you have to have a tiny, tiny, tiny weight on gamma, on the actual static inflation rate target or the Taylor rule. Because we're still seeing everywhere, except possibly in the US, real policy rates being seriously negative. Now, why are central banks still behind the curve? Why are they, both regards interest rates and balance sheet size. Right? Because the time to shrink is clearly there. If we don't shrink in times of healthy growth, right, when will we shrink the balance sheets? Persistent errors in analysis and forecasting. They were there. It was all going to be transitory and temporary. Fear of domestic instability, valid concern in terms of the speed, but not ultimately the magnitude of rate changes. Fear of international repercussions, that has actually played a remarkably small role. Advanced economies don't, on the whole, pay any attention to the EM repercussions of their domestic policy rate changes. Fear of complicating the funding of fiscal deficits and public debt servicing. I think that plays a role in the euro area. And there is the reluctance to engineer the slowdown in aggregate demand required to achieve the desired reduction in inflation. Now, we are going to be faced with global stagflation again, because we may see an escalation of the Ukraine war, could go nuclear. We are likely to see the PRC invasion of Taiwan sooner or later. And the next global pandemic is also a question of whether, when, rather than if. But secular inflation and secular stagflation, therefore, are monetary policy choices. And I do believe that despite the failures of monetary policy thus far, that ultimately our policymakers will catch up with their targets. Now, as regards deglobalization, I have a somewhat qualified position here. The just-in-case supply chain and inventory management does not itself call for deglobalization. It calls for diversifying supply chains to address all relevant dimensions of risks. Reshoring is not in general the right approach for just-in-case supply chain disruption. But it is what we are going to see, because of the deepening and widening Cold War between the US and China, we're going to see a bifurcation of the global economy into a bloc, a Western bloc mainly focused on the US, and then an Eastern bloc focused on China. Nations outside the Western and Eastern blocs will try to maintain economic relationships with both blocs. This will become increasingly difficult. And this bifurcation of the global economy will be one contributor to stagnation, to low underlying growth. Okay. On monetary spillovers, I think monetary spillovers between advanced economies are material only when they impact financial stability. Domestic financial stability issues can be addressed effectively through enhanced lender of last resort and market maker of last resort operations, guaranteeing deposits, and more stringent regulation of banks and non-bank financial intermediaries, and making sure that appropriate debt restructuring mechanisms, that orderly debt restructuring mechanisms are in place. Spillovers from the advanced economies to EMDEs are a material issue, and it may call for gradualism, sort of a low value of gamma, but not ultimately a lower long-run policy rate. As regards international lender of last resort operations, we've seen a few positive measures. We just saw a minor extension of the US dollar standing swap lines and the other currency swap lines with the 6 central banks that have these standing arrangements with each other. They could extend the duration of these swaps beyond a week, make them more effective. I think it's important to extend temporary dollar bilateral liquidity swap lines beyond even the maximum number of central banks it was extended to in the past, which was the maximum number historically has been 14, but only 2 of them were emerging markets, Brazil and Mexico. And that's where the swap lines really are needed. The repo facilities, again, can be extended. They're only for overnight repos. They could have the duration extended. And finally, there could be another SDR allocation by the IMF targeted at EMDEs, but I have little hope that if they do this, it will not be extended again in proportion to the original capital subscriptions, which means that the vast majority of the money will go to advanced economies. The Eurozone needs cross-border mechanisms for dealing with what are likely to be material financial insecurity and public debt insecurity issues during the years to come, as interest rates continue to be high and will go higher to bring inflation down. We have some instruments. Selective reinvestment of PEP redemptions is one way of addressing sovereign funding issues. The Recovery and Resilience Facility, although most of that has been used up. Outright monetary transactions requires an EFSM-ESM program and is therefore exceedingly unpopular with member states. The Statistical Protection Instrument is, in my view, just a user-friendly version of the OMT, slightly longer maturities as well, because it does not require an EFSF-ESM program. All these things should be ready and are likely to be used in the years to come to deal with financial stability and sovereign debt issues, starting in Greece and Italy, but possibly spreading further. It's important that orderly sovereign debt restructuring mechanisms be in place as well. It's important that only debt instruments with appropriate CACs should be allowed. That's the case now for new instruments, but not yet for all outstanding stocks. Official creditors should be pari passu with private creditors. I think this preferred creditor status should be done away with, and we should create a formal and effective SDRM for the Eurozone. Finally, on the energy security, green and other ESG issues and geostrategic challenges, what should central banks do about them? Well, on adaptation, everything. On mitigation, targeting these things, I think effectively nothing. They should only be in the preference ordering, in the objective functions of the central banks in a lexicographic manner in the last place. Objectives of central banks are first, financial stability, because it is a precondition for price stability or a dual mandate. Second, price stability or a dual mandate. And then third, subject to that, without prejudice to that, all things bright and beautiful, including energy security, climate change, global warming, through the geostrategic objectives and all that. Central banks should be fully aware of the implications of energy insecurity, of climate change, and other manifestations of ESG for the financial stability and price stability or dual mandates, right? But they should not use, I think, their capital requirements or their liquidity requirements, for all I know, to target environmental or other objectives, because the instruments simply, the redundant instruments are not available. These instruments that are at the disposal, both interest rates and the size and composition of the balance sheet, these instruments should be devoted fully to the task of price stability, the dual mandate, and financial stability. So adaptation, yes. Mitigation, no. Thank you.
Thank you very much, Willem, also for bringing us back to the topic of monetary policy. At times I was thinking this session 3 is in a different world from session 1 where all the inflation indicators were going down, the activity indicators were going up, and now we are talking here about stagflation, so it seemed to me really 2 different worlds. We are now proceeding with the lead questions. First, Ulrike Neyer from the University of Düsseldorf. I hope you have the microphone. It is coming there. Somebody.
Thank you. So thank you very much to all 3 presenters. I also come back to monetary policy and global shocks. So what we could observe is that in the euro area, the global shocks, so the invasion of the Russian invasion to the Ukraine, affected the economies very differently. So inflation rates in the Baltic area increased to more than 20%. In France, Belgium, it was less than 10%, so a huge difference. And this may impede the transmission mechanism of monetary policy. So my question is, do you think that a central bank of a monetary union should consider these huge differences, and if how? You may say, no, we make one monetary policy for the whole euro area, so a single monetary policy. But the ECB also said that if the interest spread on government bonds increase more than what is fundamentally justified, they will activate the TPI or they will use the PEPP reinvestments more flexible. So they also treated countries they will also treat countries differently then. So do you think with these huge differences in the inflation rates, it should be also a matter for the ECB?
Thank you very much. I'm tempted to add something to that because having looked myself at the data, what you see is that these differences in inflation rates are not so much related to difference in the economic structure, but differences in national policies. So if you have a national government that electricity prices cannot increase, the HICP will not increase, but the economic effect is perhaps the same. And I know the ECB has done some research on what we actually get from hiding inflation via administrative measures.
Yes, I know that you're right. And there are also structural differences, how gas contracts are made of the households, for example. This also includes for this. But nevertheless, the inflation rates differ. And the question is whether the ECB should consider this.
Thank you. Beat Siegenthaler, now from Rokos Capital. On your...
Yeah, thank you very much. Willem Buiter was putting up some, almost outrageously looking estimates of the Taylor rule-based where interest rates should be. On the other hand, Fabio Panetta was pointing out that bank lending here could contract rapidly, and bank funding could also costs could rise rapidly. So if I had to put the both of you on a Hawk-Dove scale, it's pretty clear where both of you would stand. But I would like to ask you kind of the same question in a way to both of you, which is, given what we are currently seeing and the tightening that we could see based on this banking story, how much would you say could be the equivalence in terms of rate tightening, interest rate tightening, maybe in a scenario where this gets worse, how much in Willem Buiter's view would those rates come down, and in Fabio Panetta's world, when would we have to stop tightening or maybe even cut, if the way they dare say it even. And just the second question, if I may, more to Mr. Panetta's presentation, there was a very interesting chart with profit margins, which really ballooned in Q4. And one could read this in a way, one could say, well, obviously demand in the economy was very strong, which allowed corporates to get those profit margins. Now, why are we thinking that this will change, or maybe these profit margins will just remain very high if demand remains high? Thank you very much.
Thank you. And the last question does not come from Jörg Zeuner, Union Investment. He unfortunately cannot be with us today, but it's Florian Henze. Please go ahead.
From Union Investment as well, yeah. So I have a question on the impact of global shocks on inflation targets. So the debate resurfaced basically last year in the US on raising inflation targets, not obviously by the Fed, but by Olivier Blanchard, etc., after it basically surfaced 10 or 15 years ago. The trigger being, among other things, basically the list of supply shocks that Nouriel was mentioning, and as a consequence, sort of structurally higher inflation. Now, the debate has so far been pretty limited to the US, not much going on in the Eurozone, and of course, now is not the time to talk about changing inflation targets. So I'm trying to ask my question in a general and more long-term way that even maybe Fabio can respond to it. Should and will inflation targets for central banks in advanced economies be higher, stay the same, or be lower, let's say in the second half of the 2020s relative to now? Thank you.
Thank you. I think, Fabio, you have a full plate.
Well, first of all, let me say that when I came here today, I checked my speaking notes. I have no reason to sound pessimistic. So I checked my speaking notes several times because I didn't want to sound unnecessarily pessimistic, and look where I ended. We had a session which, but on the questions, there are different inflation rates in the euro area that depend on national peculiarities. The composition of the energy mix, the structure of the economy, how far the country is to the eastern border. This is an issue for the level of inflation, but transmission mechanism is working. The indications we have on the transmission of our policy rates to markets at large in the euro area is, from an empirical point of view, that our monetary policy is starting to bite. Of course, the effect of our monetary policy has not emerged fully, but we don't see situations in which it is not working. On the Taylor rule, I took Willem's estimates of the Taylor rule as a provocation. On the effect of the banking crisis, this is a phenomenon which has emerged a week ago. Let's see if it is temporary, if it is permanent, how much it will spread beyond the United States. It's very difficult to attach a value to the potential increase in the power of the monetary policy transmission. Certainly from a qualitative point of view, it is true that banks now understand very clearly the risk of losing funding, and they will not accept any outflow of funding. They will react by passing on the rate hikes to their customers on both sides of the balance sheet. This means that a hike will be transmitted more than in the past to deposit rates, to lending rates. It also means that banks may become reluctant to lend to some sectors. In a phase of high uncertainty, where there is a contraction in the supply of liquidity, some sectors that are more dependent on liquidity, that are more sensitive to liquidity shocks, and the tech sector, for the Silicon Valley case, is the example. Those sectors might become, banks might become less willing to lend to those sectors. Now, the ultimate effect will depend on the composition of the underlying economy. So there are a number of factors that is very difficult to estimate on the spot. But certainly from a qualitative point of view, the impact of the recent tensions will be that monetary policy will become, the transmission of monetary policy will become stronger. Yeah, on profits, I don't think it's only demand. Because if it were an issue of strong demand, then the increase in profits and the divergence between wholesale and retail prices would affect different sectors across the board. We see that this is the case only for some sectors. Maybe that the confusion determined by high and volatile prices is felt more in some sectors. Maybe that some sectors are more concentrated than others, because there is, in my introduction, I alluded to the possibility that there is some market power by producers in some markets, and conditions may differ across sectors. Certainly, there is a very peculiarity in the cycle we have seen in the last 2 years. We had a recession with very high profits. And the profits remained high because the public sector stepped in and shielded companies from the consequences of the pandemic, of the supply shock we saw during the pandemic and after the Russian aggression to Ukraine from the energy crisis. Of course, from the point of view of the central bank, the only thing we can do, if we see that profiteering strategies by some sectors do make core inflation stickier, the only weapon we have is to respond with monetary policy. But I tried to argue that there are other policies that, because this is a way of, this is an externality that is coming from those sectors that are taking advantage of the of the asymmetric information on prices to increase their profits, and then sharing the cost of this action across different sectors. So a monetary policy intervention would have an effect across the board, and de facto you would be sharing the cost of the policy reaction to that strategy. Maybe there are other policies, and I mentioned policies that may intervene in case of abuse of market power, that are more targeted, and maybe they are less costly to others that have nothing to do with these strategies. On the inflation target, raising the inflation target, I think that 2% is a good number. And I think it was defined by the Governing Council, and I was there as a super backbencher when the Governing Council with Otmar and others discussed. And I remember the long and laborious discussions which were based on the Bocconi report, on the need to allow adjustments in the euro area in terms of competitiveness, and 2% was the right number to set. And on top of this, on top of the fact that 2% for me is the right number, it would be very unfortunate if a central bank that is not a target started even discussing a change in the target. Would sound really a trick, which I don't think would be useful and would backfire. I hope that was clear. It's no.
Very clear. Willem, your Taylor rule estimates have been mentioned. When I saw that, I was thinking, where would your estimates end up if you put in the numbers which Philip Lane presented earlier today for the end of this year?
It would be significantly lower, but I think these numbers are extremely optimistic, and I don't believe we will have them unless we raise interest rates significantly higher. So, does that answer the question?
That is one answer to the question. There are many possible answers.
Okay, so Nouriel is next with his comments, or should I answer the other question?
Why don't you go first and then...
Okay, thank you. should central banks consider huge inflation differences between countries? Well, there's one monetary policy. You target the economy-wide average rate of inflation. That's it. It's obvious, I think, that the euro area is not an optimal currency area, but it is a currency area, and so live with it. Use national fiscal policies, other regulatory policies to deal with asymmetric shocks where you can, and otherwise live with them. Second, how much would rate hikes be impacted by credit tightening, threats to bank lending, and possibly banking crisis? Well, I certainly say that the speed of rate hike increases should be affected by this, but ultimately, the level of the risk-free nominal policy rate really is not a major driver of financial crisis, and it should be really set with references to medium and long-term inflation target. Finally, should we do something about the inflation target? I think we may well have to. I would lower it, most likely. The reason is the following. You want to target, if there's no constraints on your interest rates, the true zero, right? And for some reason, I think based on research which goes back quite a long time now, people estimated that the bias in the typical CPI index may have been 1.5 to 2% inflation. So in that case, you, or some estimates higher. So in that case, 2 would be the estimate of the true zero. The only reason, if you believe that the true estimate is lower, as I do now, not to go straight to the new target of, say, 1.5 or 1%, is that you have the effective lower bound on interest rates. Well, there's a solution to that. Do away with cash and create a central bank digital currency that takes over for it in a superior way. So I would not raise the interest rate for sure, and if I changed it, it would most likely be in the downward direction. Thank you.
Thank you. Nouriel, to the question which we already had, I wanted to add just the following. You outlined a very, let's say, dark scenario, but central bankers live in the here and now. Does your scenario have any implications for their policy setting today?
I'd like to answer your question and some of the other ones. Unfortunately, when you have negative supply shocks, people say central banks cannot affect aggregate supply. That's true. But if you don't fight inflation, you end up like in the 70s, where the reaction of the 73, 79 shocks was being behind the curve. You got at the anchoring of inflation expectation, you got the wage price spiral, and you ended up into a stagflationary nightmare. So in some sense, it doesn't matter that the nature of a shock is something the central bank cannot control. If it leads to potentially the anchor of inflation, you have to fight it, and if you don't fight it, then you end up in trouble. So the answer will be, yes, you have to fight it. The point I make is that in a world in which, in addition to negative supply shock, you have high debt, not only fighting inflation leads to a hard landing, and therefore you don't have anymore the option of a soft landing, but you also led to financial instability. So you're facing essentially not just a dilemma that to fight inflation I have to cause a recession, but you're facing a trilemma that to fight inflation I cause also financial distress and a financial crisis. Now, one point about some of the observation that Willem was doing. In the first slide, he spoke about a number of factors that lead to secular stagnation, meaning lower growth. And I do agree, whether it's deglobalization or demographics or global climate change or resistance to inequality or geopolitics, growth is going to be lower. But these are factors that lead not to secular stagnation with low growth and low inflation, but they lead to secular stagflation, lower growth and higher cost of production. So for me, there are sources of medium long-term stagflation rather than secular stagnation. You observed also that the existence of excessive debt could be a source of secular stagnation. And the usual argument is if there is too much debt, that crowds out demand, people have to spend less. But as I pointed out, in a world in which there is too much private and public debt, you end up both in fiscal dominance and financial dominance. And de facto, you cannot fight inflation, and you have to monetize it. So you end up with higher inflation. Couple of additional points. De jure, central banks are not going to change their inflation targets from 2% to something more, even if in principle you can make some arguments in favor of it. And the usual argument is if we go from 2 to 4, how do we know that we are anchoring inflation expectation at 4% as opposed to then they get the anchor to 5, 6, and whatever. That's effectively what happened in the 70s. That's true, but I fear that when I end up in a situation in which de jure you're still sticking to 2%, but because of the existence of all these medium long-term stagflationary shocks, a debt trap, fiscal dominance, financial dominance, and the risk that if you fight inflation, you cause an economic crash and a financial crash that feed on each other, de facto, you're going to end up with a situation in which inflation is going to be higher than the target. And I don't know how they're going to explain it, how they're going to fudge it, and so on, but that's where they're going to be ending up. Final observation on the issue that there was a differential in inflation rates across Eurozone countries. I think, Daniel, you had it right. Most of it is not driven by structural factors or dependency on energy. Most of it was that France decided to massively fiscalize the energy stuff and subsidize everybody. And most of other European countries did it to some extent, and some countries did less of it. But the consequences of those fiscal action are deleterious. If you want to have the green transition, you should allow fossil fuel prices to be as high as the markets want them to be, so that you have an incentive to move from fossil fuels to producing alternative energy. And if you massively spend a huge amount of money to fiscalize those energy costs, in the short run, you're repressing official inflation, but that increase in aggregate demand is going to be inflationary at a time where the permanent shock requires you a reduction in consumption. You react and adjust to a transitory shock. You finance it, but you have to adjust to a permanent shock. And that makes more difficult, of course, the job of the ECB, because you have more stimulus, more inflation, and then the ECB has to do more. So it's an inconsistency between monetary and fiscal policy.
Thanks a lot. With the permission of Volker, I will allow for a few questions, or okay, let's keep it short. We start perhaps 1, 2, 3, and I have my left eye open. No, okay.
Thank you.
Short questions?
Sure.
No statements?
No.
And very short answers then.
Sure. Brunello Rosa from Rosa and Roubini. So, to Fabio Panetta, I mentioned the importance of clear communications, but from the ECB. But recently, the ECB said that it was deciding meeting to meeting, while at the same time pre-committing to a 50 basis point increase six weeks in advance. This seems to me potentially communication mistakes, and everybody has praised the ECB for adopting the PEP. Of course, it was important, but this came 2 weeks after Madame Lagarde said that the ECB is not here to cause the spreads. So how can we make sure that similar mistakes are not made in the future? Thank you.
Thank you. Next one.
Okay, thanks. Nouriel gave a really great overview of the stagflationary risks that we face, even predicting a stagflationary period coming up. What can central banks do to make that easier to deal with? Is macroprudential policy a potential solution to deal with that, so that central banks don't end up with a financial crisis trying to deal with stagflation? And a question for Fabio is that, do you think that after Nouriel's presentation that, considering the rather optimistic view that you sketched and that Philip sketched this morning, that the ECB may be underestimating the stagflationary forces that it faces, since there was so much emphasis put on how inflation is coming down? So do you think the ECB may be underestimating the stagflationary forces it's facing?
Could you perhaps hand the mic down to Ulrike first? And then if she can, to Andrea? Or to Michael Bordeaux? Okay. Thank you.
Okay. Yeah, I have I guess this is for Nouriel, who I know for a long time, and a little bit for Willem. So look, I'm an economic historian, and there's one factor you guys didn't talk about, and that we all talk about, and that is the growth of technology. Okay, I mean, since the Industrial Revolution, that's the driving force in economic growth, and I didn't hear either of you talk about that. And other thing I was going to say, which is kind of aimed at Fabio, but also the other ECB people, is why doesn't the ECB accept responsibility for the inflation? You're always talking about shocks here, shocks there.
Thank you. 3 simple questions, and we are in overtime, so I really would like you to be telegraphic. And I propose we go in the opposite order. Willem, why don't you go first?
I'm not sure what the question was, other than technology being a major driver of future growth. Yes, I agree with that. But and while I believe there's lots of exciting stuff going on in the AI and related fields, I believe that the political approach to permitting their introduction because of its impact on unemployment will make for a lower rate of underlying productivity growth than would be possible in a world with unbridled capitalism.
Nouriel?
Well, in the list of factors that led to the great moderation, I spoke about 6 positive aggregate supply shock, and one was technological innovation. What I pointed out was that most of those positive, like globalization becoming deglobalization, migrations becoming restriction, geopolitical depression and a dividend, and I explained there are 10 of them that are stagflationary. Yes, there is one left that is technological innovation. In the long run, it might lead to positive deflation, but for the next decade, you have 10 forces go in the other direction. Secondly, this technological innovation yet is not showing in the aggregate productivity numbers. We don't know why. Maybe it's a lag, like it happened in the internet. 3 is going to lead to massive technological unemployment, massive increase in income and wealth inequality, because capital intensive skill buys a labor saving. Therefore, there'll be some political backlash against it. There may be even restriction to its own adoption. And final point about technology is, every technological innovation has been driven in the past by governments who want to build bigger bombs to fight bigger wars. That's why, last year, when Eric Schmidt, former CEO of Google, wrote this book with Henry Kissinger, the foremost geostrategist in the US on geopolitics, about who's going to win the war on AI between US and China, they made the point it's not going to be only who's going to be controlling the industries of the future, but it's going to be the major geopolitical security military power in our century. And we are on the verge of another clash. So those are the dark side of technology.
Thank you. And Fabio, cheers up.
On the communication, I referred and I think that also the Philip and the President referred to the need to communicate clearly in order to address the natural tension that exists in relying on a meeting-by-meeting approach, but giving a direction of travel. And the only way we can do it is to have a clear, well spelled out reaction function and communicate clearly on it. And this is what we are trying to do. On the risk of stagflation. Stagflation is characterized by low growth, high inflation, and high inflation expectations. We do not have that in our projections. Inflation has spiked up due to a sequence of shocks. Many had forecasted inflation, but for totally different reasons from those that have brought inflation up. I didn't hear anybody projecting or expecting of forecasting the war, manipulation of energy prices, the energy shock. I never heard anybody talk about bottlenecks, which are a large part of the determinants of the increase in inflation, but we are reacting to those inflationary pressures, and we will continue. And as the President said, we will bring inflation down to 2%. On your comment, I take that as a joke. Thank you.
Thank you very much.